So let's say you have $100 to invest, and a very common thought would be, is that enough to get started? The answer is absolutely, but here's the catch. In a market that's been on an absolute tear for the last 3 years, it is getting harder and harder to find no-brainer investment opportunities, especially in those sexy companies with high growth. Today, we're going to cover 3 stocks that some people believe investors are sleeping on right now. All 3 of these stocks are selling below $100 per share. I'm going to analyze them to see if they have real growth potential, do they have real cash flow, and most importantly, are they selling at a reasonable price that we can buy them at? Now, for anyone who's newer to the market, here's some quick context. In 2023, we saw massive returns, coming off a correction the year prior. In 24, even bigger returns as momentum continued. And now in 2025, the year started off really poorly, but the S&P is now up 16% year to date after rebounding from that turbulence earlier in the year and bottoming out in early April. But here's the thing that no one is telling you. A lot of that growth has been driven by just a few mega cap headline stocks. Meanwhile, certain quality growth names are still trading at reasonable prices despite very strong business performance and growth. At Everything Money, this is exactly what we're looking for. Companies with solid fundamentals, real business momentum, and the final piece, and the most important piece, they are trading at reasonable prices. Now, I want to remind everybody what reasonable prices mean. Everyone is following what's the price of the stock. Guys, that is not what's important. What's important is, what is that giving me? Berkshire Hathaway's Class A shares are selling for hundreds and hundreds of thousands of dollars per share. But it's actually a less expensive company than Tesla or Nvidia, which is selling for a couple $100 a share. This is the article from Motley Fool. The headline is 3 no-brainer growth stocks to buy with $100 right now. And I get it. Headlines like this are meant to grab attention. But that doesn't mean we can't learn something useful from it and find potential opportunities. The article talks about the historic run that the S&P has been on over the past 3 years, but highlights 3 names they believe are poised for high performance heading into 2026. Here are the names they feature. Marvell Technology, a lesser heard AI company than NVIDIA or AMD, but they're doing important work with Microsoft and Amazon. Second, DraftKings, a leader in online sports betting, showing strong signs of expansion despite regulatory pressures and new competitors entering the market. And finally, Uber, which is not just a ride-hailing machine anymore, but also a platform aggregating demand for delivery and even autonomous vehicle fleets. So let's break these 3 companies down, put them through our process, starting with Marvell, to see if today's price makes sense. So here's Marvell Technology. Again, $87 per share. But what's most important, guys, the market cap, $72.8 billion. This tells me if I bought every single share outstanding, how much I have to pay to own every single company. And here's what I also like. Enterprise value of 77.6. That $5 billion difference is essentially their net debt. So they have essentially $5 billion of debt, and they generated $1.6 billion last year in free cash flow. So basically in 3 years, they could pay off their net debt. That is awesome. One thing I don't like, their return on capital is not very high. What this stat means is this company able to generate good returns on the money that has been invested in the business, either through debt or through equity? The higher the number, the more efficient the company is at making money. Now, more about Marvell. They're becoming a quiet force in the AI chip space, building custom AI accelerators and high-speed networking chips used by giants like Microsoft and Amazon. Management is guiding towards $10 billion in revenue by 2026 as new chips ramp up their production. The company's recent acquisition of Celestial AI, which specializes in photonics, is expected to drive $1 billion in annualized revenue within 3 years by enhancing Marvell's optical interconnect and AI accelerator offerings. The question becomes, through all of that very complicated jargon, is this one of the few AI-related growth names that is trading at a reasonable price? Now, I want you guys all to remember, that was us finding data on the internet about what Marvell does and their stats. It sounds very complicated and cool. We like to keep things very simple. That's really, really important, okay? I went through a few stats already on Marvel. Guys, look at this. This is what's interesting to me and a little apprehensive for me. Their 10-year profit margin, 3.73%. Their 5-year margin, negative, basically break even. Last year's profit margin, 31.75. So a lot of people would look at that and say, this is awesome. What I'm going to sit there and say is this temporary? Can you bank on this for a long period of time? Guys, they only have 1 year. This company's been around for how long? Let's look at the chart. The max, it's been a publicly traded company since 2000. This is, you have to ask the question of, is this a permanent plateau for the company? That is a very important question to ask, all right? Gross profit, very good. Over 50%. For a chip maker, that is very solid. We like that a lot. Revenue growth, 10% a year for the last 10 years, 22% for the last 5, 10% a year for the last 3. And guys, only $3.7 billion in acquisitions in the last 5 years. So it's not like they're really massively growing through acquisitions. So I really like that a lot. Now, guys, if this seems overwhelming, at some point in everybody's career, it was overwhelming. No matter who it was, Warren Buffett, Charlie Munger, at some point they were overwhelmed. That's what makes teaching on YouTube so wonderful. It's a way to simplify all of this and get people exposed to that. But even better, all of these metrics here, I really want you to understand them. It's really important for you to understand them. So I made a very simple and easy cheat sheet ready for you to download. Click the link below. Get the cheat sheet sent to you. It'll give you all the key metrics, explains them, tells you why there's important. It's really important before we go analyze the company, which we'll do in a few minutes for a stock price, to understand what's the story behind them and what do these numbers all mean together. If you really want to elevate your investing game, you got to go do that. So let's check out the 8 pillars here on the company. What's the story telling us with the 8 pillars? 4 X's, 4 checks. This is a very typical look of companies that are kind of in between. I mean, we have revenue growth, we have net income growth, we have profit growth, cash flow growth, which I like that net income and cash flow have grown pretty much in line. The other thing is revenue is up $5 billion and net income and free cash flow is up $1 billion. That's basically a 20% margin. Okay, so maybe this margin is a little high in the last year. Let's go check out why that might be. Was there any sort of short-term gain that they took? So other income expenses, no, only $6.5 million in the last year. So I'm not seeing any extra ovens, but yeah, I'm not seeing anything big here. So maybe the company is just better, but look at the history here. Loss, 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 $1.6 billion gain, loss, 500 million. I mean, it's very inconsistent. So guys, let's run the stock analyzer tool. Analysts are expecting them to triple their revenue in the next 5 or 6 years. That's a lot of growth. All right, let's go sit there and let's see if I've ever done Marvel before. MRV in my history. MRVL. Have I ever done it? About a year ago. So let's see what I did. So first off, low returns on capital. This is not a good sign for a company. It means they're not, but at the end of the day, this is still a growing company, even at $78 billion market cap. I'm doing a 10-year analysis. What's my revenue growth assumptions for the next 10 years? I did 4, 7, and 10%. I'm actually going to make that a little bit bigger. I'm going to go 8, 12, and 16. Now, profit margin. This is where we get confused. 31% in the last year, negative for the last 5, slightly positive for the last 10. Free cash flow, though, a lot more consistent. So I'm going to make free cash flow and net income equal because this is the more important number. I'm glad it's higher, but I want to make sure we focus on that number here. So I'm going to sit there and say, let's go with 15, 20, and 25. And the reason being is, as you saw in the last 5 years, their net income was up 20% and their cash flow is up 20% on their revenue. So I look at that saying, maybe that's a pretty good number for the middle, a stabilized 20% profit margin. Now, what is the PE you'd put on this company 10 years from now? 10 years from now, not today. And we used to put the current PE in here, but I found that people attach themselves to that number. Guys, that's not the way to look at it. The historical average for the stock market is 15 or 16. You go higher for good companies, lower for bad companies. Now, Marvel's kind of a mixed bag. We've got bad returns on capital, which is not a good indicator for a good company, but a lot of growth potential in a good industry with great margin. So I'm kind of going in the middle here. I'm doing 13, 16, and 19. Is that too low? Maybe. I don't know what people are going to put out there, but this is why you get the software, because it allows you to sit there and make your own assumptions on this. And then finally, what is my desired return? Guys, I just want the intrinsic value. What's the company worth based on the market returns? I put in 9%. Of course, if you're going to buy this company individually, you need to put a higher return in there for a larger margin of safety. I hit the analyze button. And guys, I have a low price of 28, high price of 108, middle price of 56. And this 4.2% return is based on my middle assumptions. It includes any dividends the company would pay. So right now I'm like, I made some assumptions in there that I think are pretty reasonable. So maybe I'm the low side, but I'm not looking at this thing and thinking this is an obvious deal. Now, the issue is most investors lose money because they're trying to focus on picking the absolute next winner. That's the wrong way to do it. We use our process and we use Stock Analyzer tool to ensure that we're avoiding the big losers. What that means is our fifth tenet of our principle-driven investing is a great story becomes a bad investment if you pay the wrong price. The way an investment becomes a loser is paying the wrong price. You can lose money on a great company because you paid the wrong price. Now, we sat there and did this title on this video to sit there and tell people like, hey, these are 3 stocks to look at, but we're here to teach a process. We grab you in with that title, but we're here to teach you more and more. So if this is making sense to you, and especially if you're a new viewer, keep on watching as we do these next 2 companies. So next company, DraftKings. Now, guys, I'm not a sports bettor. I've gotten a little bit into it lately, but I'm doing like $5 or $10 bets. I do one big bet a year. As a Michigan grad, I bet on Ohio State, every Michigan-Ohio State game, because I want to sit there and hedge my emotions. If Michigan wins, I'm happy to lose the money, and I bet a lot of money on it. And if Michigan loses, I win money with Ohio State. So I kind of sit there and say, well, we lost, but I got money. Oh, we won. I lost money, but I'm happy that we won. So that's what I do. DraftKings, I don't use. I personally use FanDuel. Now, DraftKings is an $18 billion business. They remain the market leader in online sports betting. They have strong user engagement despite regulatory concerns and rising competition from prediction markets. NFL and NBA betting volumes are both up year over year, and the company is improving its profitability with better hold percentage, thanks to a surge in high-margin parlay bets. Guys, parlay bets are very popular, and they're very fun, but they're very unlikely to hit. Now, recent high-profile deals with NBC Universal and Disney's ESPN have also strengthened its brand and expanded its reach. With decrease in marketing spend and tech costs, the company could be poised for strong bottom-line growth in coming years. That's very important. These companies are spending like crazy. Guys, we had a startup called Dynasty Owner where we had a fantasy football game. The competition in the space absolutely wiped us out in terms of our cost per acquisition. Getting these costs down is very important for these companies because for a while there, they were spending whatever it took to get something on their platform. And it made sense. If they got you on FanDuel, what was the chances of you going to DraftKings and vice versa? So it made a lot of sense for them to spend money. So again, $17 billion market cap, $530 million in free cash flow last year. And look at this. 5-year average was negative 190, 180. And look, net income far lower than free cash flow. Guys, we rarely see that. And we've seen it now in 2 companies. I like that a lot. Profit margin was negative, but free cash flow was up. Not a ton of debt. Only about $2.5 billion of debt, so pretty reasonable. Look at these growth rates. 5-year revenue growth, 67% a year. 3-year, 43%. Gross margin, 39%. What I want to see here, actually, let me go look at this. I want to see what the gross margin has been by year because I want to see if that gross margin is getting better. What is gross margin? It is every dollar they sell extra, how much of that goes to the bottom line before overhead and taxes. So it's basically every single time you make a bet, what are they making? So in previous years, let's go back to 2017. What you do is you take the gross profit number and divide it by the revenue. Wow, look at this. That was like 80% right here. Now higher than that. Here, about 80%. Here, about 67%. So it's getting lower and lower and lower. It's getting lower and lower as time goes on. Here, it's still about 40%, which was about 39. Yeah, so, okay, so their gross margin is getting lower and lower. The question is 40% reasonable? As that gross margin gets lower and lower, what's going to happen to profit? Something to look at. Let's go to the 8 pillars. Blah. But guess what, guys? This is a growth company. You got to sit there and kind of throw this thing out of the door. Let's see what analyst estimates are. Oh, wow. Look at this. They have the company making 27 cents a share this year, growing to $4 per share in 5 years. At 20 times earnings, that's an $80 company. And the stock is currently selling for, I didn't even look what it was selling for, 35. Okay, so if analysts are right and you apply a 20 earnings multiple, PE, to the company, you can over double your money in the next 5 years, assuming all of these things play out. That's the question. Revenue growth, look at this. 30%, 20%, 16, 18, 7, and then 10. So definitely decreasing revenue growth. I guess the market basically says in the next 5 or 6 years, the leaders are going to be there. And if DraftKings is still a leader, it's going to be good for them. Let's go to Stock Analyzer tool. What is this company worth to us? Let's see if I've never done it before. Look at that. So now we get to make assumptions. Okay. Revenue growth for the next 10 years. I'm going to put in 8, 12, and 16. Profit margin. I'm going to focus on free cash flow, and I'm going to assume at 40%. I'm going to give them a little bit of a benefit of doubt. I'm going to go 10, 16, and 22. Now, guys, the issue we have with companies that have this kind of history, you're guessing. All the more reason to have a higher margin of safety by putting in a higher desired return. I would focus on the desired return for the margin of safety. Now, I matched profit margin and free cash flow because over long periods of time, they should equate out. What is the PE to apply 10 years from now? Well, negative returns on capital, that's poop, but it's obvious because it was a growing company losing a lot of money, so I'm okay with that. If they're the leader in this industry, I would give them 15, 20, and 25. Okay? And then finally, my 9% return. Hope is not a plan. I used to buy stocks hoping that they would go up, but hope doesn't protect you when the market turns. Hope doesn't help you sleep better at night. Hope it doesn't decrease your fear. I had to learn how to build a real strategy, one that makes sure that I personally never go to zero. Now, every investment I make is based on numbers, not hype. This is why I built Everything Money. It was built for me. I wanted the tools that gave me clarity, took the fear out of investing, and helped me make better decisions that helped me sleep better. People saw me using them on YouTube and said, Paul, can you give us that software? And I said, well, I can't because it's mine right now, but I can create it. And so I did, and a real community was born. Real people sharing ideas, live chats, live streams, and tools that help beat 99% of investors. I still use these tools like the Stock Analyzer every single day. Stop guessing, start learning. Click the link below, try our trial, $7 for 7 days, and see how confidence will replace your fear. We hit the Analyze button. Boom, the stock's currently $35 per share. Okay. We have a low price of 25, a high price of 143, a middle price of 64. Now, one thing I want to show you guys before we go further on our 8 pillars, this is what I don't like. This is the unknown, dilution. So that price looks like a pretty good price, but what if all of a sudden they double their shares in the next 5 years? You're not going to get that benefit. Because if a company has 10 shares and you own one, and they double the number of shares, I'm not talking about a stock split. They literally have to sell more shares. So they have 20 shares outstanding, you still own one. You have 5% of the company versus 10% before. So even if they double the business, you've seen no gain in that. That's something to really understand in growing businesses like this that still have to raise money to grow. Be very cautious of that. Increase your margin of safety for that reason. Our final company has captured the attention of our community members. I did a video on this a while back, and I was like, oh, this is pretty interesting. Uber is now a verb. When people need a ride, they say Uber it. The company holds a massive 76% of US ride-hailing market. That is huge. Additionally, engagement is rising fast. Monthly active users grew 17%, with trips and gross bookings up over 20%. Guys, that is operating leverage. The company is also building a strategic position in the self-driving vehicle race, partnering with Waymo, NVIDIA, and others to power next-gen mobility. Earlier this year, super investor Bill Ackman announced a $2 billion position in Uber, the largest in his portfolio. Shares of Uber have risen significantly from lows earlier this year, along with the market. So now we're going to use our stock analyzer to determine if today's price still makes sense. So year to date, it's up 26%. At the April lows, it was at $64 a share. So it's actually not even up that much. I mean, it's actually pulled back quite a bit since its April lows. That's interesting. It's a $174 billion company that is now focused on free cash flow. Now, last year's free cash flow was $8.7 billion. Last year's net income, $16.6. So big discrepancy there. You got to understand why. Let's go look. Let's see if they had a big increase. So free cash flow is cash from operations less capital expenditures. Capital expenditures are very low on this company. So it's a little concerning as to why their free cash flow is so much different than their net income. We'll get into that probably in the community sometime. Let's go look at the 8 pillars here. Ooh, another ugly one. So guys, all 3 of these companies had ugly 8 pillars. But remember, the 8 pillars are backward looking. We don't know if that means anything about the going forward. It's more to tell a story, not to say buy or don't buy. I do like some of the things here. The only concern is revenue's up $38 billion, profits up 23.5%, and free cash flow's up 13%. They also have some dilution along the way. Again, something to watch for. Let's see what analysts think about the company. Not as great as I would have thought. $3 a share this year, growing to almost $6. So doubling in the next 4 years. I would have thought higher than that. But it's still solid growth. And revenue growth, okay, see, this is what makes sense to me. 18%, 15, 14, 13, 9% revenue growth. Pretty solid revenue growth. I guess it does make sense. Doubling. The revenue's not up double, but the profit's up double. Actually, it does make sense. I take my statement back. So again, we go back to one thing. What is the company worth to us today? So let's pull up the last time I did this company on our stock analyzer tool. I cannot, oh my God, Boober. Okay. I did a 10-year analysis. I did 6, 9, and 14% revenue growth. Profit margin and free cash flow margin, I did 18, 22, and 26. This is going to throw you for a loop. That 33% in the last year on profit. I'm still giving them upside and everything else. I'm still comfortable keeping it that 18, 22, and 26. Ironically, what PE? I picked 18, 22, and 26 as well. It is the verb, Uber, let's Uber to the store, all these things, and a 9% desired return. The stock's currently at basically $80 a share. Hit the analyze button. Wow. 90 on the low side, 316 on the high side, 160 in the middle, a potential return of 18.5%. Guys, my recommendation is go do some more research on that. Now, guys, we analyzed 3 very interesting companies today. Now, if you want to learn how I generate income every month from stocks I already own using a strategy called covered calls, click the video on your screen to watch our full options course. I'll see you there. Thank you for your time.